Only large credit unions can compete in the auto refi space.
Capital F fiction. Yes, there will be a surge coming once rates come down. I think the question is, when are rates going to come down?
A lot of people don't necessarily know about, can you refinance your auto loan? Like, it still seems like there's a little bit of education out there.
Do you think the consumer even knows what their rate is most often?
Probably not. They know what their payment is.
Welcome to Leaders in Lending. This episode was recorded in mid-August, so some of the content today is subject to change. Today we're going to talk about this auto refinance surge that could be coming, right? The Fed really hasn't moved rates for quite some time now, but there's talks, depending upon which paper comes out each week, of when they will reduce the Fed rate. So there's this refinance surge that could be coming. This asset category is near and dear to credit unions. So I would love to get your both perspective on, what is driving that outside of, the Fed potentially reducing rates. Is it we're already in a refinance crunch, or is it coming? How are we going to support it? So I'd love to get your perspective on when it's coming, or is it already here?
Sure. Did you intentionally say driving, by the way, because we're talking about
no pun intended.
Anyhow, so you're right, Drew. It's been about a year since we last saw Fed funds decrease. In fact, we saw 3 decreases last year of 100 basis points total. And what did that do to the interest rate environment? I mean, the market didn't change at all. In fact, if you look at the 10-year rate today, is roughly the same as what it was 2 years ago. So that tells me that we haven't necessarily seen any sort of a change in auto loan rates in the past 2 years. And yet the majority of originations in auto loans have been in sometime between now and, say, the last 3-4 years. So yes, there will be a surge coming once rates come down. I think the question is, when are rates going to come down? Because those last 3 rate cuts really didn't have any impact on the interest rate environment. I don't know if the ones that are contemplated this fall, with everything else going on in the economy, are really going to have that intended effect on auto loan rates as well.
Yeah, and I definitely think that, that we all saw during COVID, what happened to the auto markets, and, that new cars were hard to find, used cars sold at increasingly high prices. And I think that what we've been seeing then in the last few years is more new cars are actually the ones that are being financed while they're now back available. There's less used cars available. And so people are generally then going through a dealership, buying a new car, and so may have loans that are more attracted to refinance, and a car that has taken less depreciation over time because it's newer.
That's a good point. Around the new cars, the valuations are holding. 3-4 years ago, I remember in our credit union looking at these new auto loans coming through because they were overvalued used cars, just because there was less supply available, and thinking, how are we going to collect on this in 3 or 4 years, given where values were at the time? And I think that's sort of happened, is that valuations dropped so much for used vehicles in the past 3-4 years that doesn't necessarily have as much of an impact now. Now, what that means from an auto refi perspective for those loans that were originated 2-3 years ago is you're going to have to really be very clear on valuations, and if that makes any sort of change to your policy around the loan to value that you'd be willing to accept, or if that impacts your pricing in some way, if you want to have some sort of a premium placed on that high loan to value auto loan.
It's a near and dear subject to my heart, because about not quite 4 years ago, I had one of my children got her driver's license, and we had to buy her a car in the midst of historically high used car prices. And now my youngest is about to turn 16, and things look much better. And the middle one may be a little jealous that the youngest is going to get potentially a nicer car that's a lot less money.
A brand new car, maybe, right?
Most likely a brand new car versus a couple years old. Yeah.
So on that, Lynn, you touched on that in the auto space right now, there's more new vehicles that are being purchased at dealerships. It's no longer kind of this used versus new type of mentality. If you think about, though, people that got into a car, such as they bought their daughter a vehicle or so, the rates that they were offered back then were decent in a sense, so probably somewhere between the high 6s, mid 8s, depending upon credit quality, things of that nature. But the newer vehicles that they're now selling are much higher trim packages, higher payments at APRs right now that are still fairly high. What do you think moves the needle for people to go back to purchasing new vehicles or refinance their existing? And how many basis points does the Fed reducing? Does it make sense for them to go into a comfortable payment if they were to buy used or versus new.
Yeah, I mean, in a refi deal, if there's no other sort of fees associated with it, and typically there aren't, if I can reduce my payment by $25, why wouldn't I do that? If I'm able to even stretch out the term a little bit, cars are lasting a lot longer now too, right? And what's the average age of vehicles on the road right now? It's over 10 years. Just because quality, I think, is way better than it was a generation ago. So maybe I'm willing to extend that term out a little bit in order to get a little bit of a lower payment, even if my rate isn't necessarily all that different.
Mm-hmm, mm-hmm. Well, I certainly know. I know on one of our prior episodes, we had some of the folks from Experian on who specifically lead their auto market in the credit report and credit scoring area, and they're seeing a lot more of that, like those longer terms, that people are taking a longer term. Now, whether or not they hold that car for very long, they're willing to take a longer term in exchange for a lower payment. And I think that is a big focus. That payment versus rate is still, for most people, the biggest number that they look at, even though the rate long term can mean more. But it depends how long they're going to keep that car, or if they're going to trade it in 3 years, or they plan to actually pay it off.
Our credit unions even did 96-month loans for new vehicles, and we could even charge a little bit of a premium for that 96-month loan and make a little more yield off it. So, and what's stopping you from doing that in the refi market? You can do the same sort of pricing approach, and take a few more basis points to make that, to improve the profitability of the product.
The refi surge is coming. We're kind of aligned there. You think about the macro though right now. Inflation, who knows? Delinquencies are up across all different asset classes, but for people that are coming through in this refinance surge, and this being the bread and butter of credit unions of auto lending, do you think they're going to have tighter policies? Is it going to be more of an open book with valuations and terms, so on and so forth? What are your general thoughts on how tight things will become, or is it going to be kind of an open book?
I'm really interested in Barry's answer on this, but I know particularly with tariffs, as we were, they've been on again, off again, on again, off again, as it relates to cars, as it relates to automotive parts. There was a surge of new car purchasing that happened towards the end of last year, earlier this year. And where people were probably buying ahead of when they really wanted to buy a car, because they were afraid that if I wait 6 months or 3 months even, this car is going to cost me thousands of dollars more than if I buy it right now. And you saw dealerships out there pushing that too, saying, hey, buy what's on the lot right now, no tariffs on these vehicles. And so I do think you have a lot of people who probably paid more and took higher rates than they would have because they were worried about the macro changing. And so it doesn't really kind of answer that specific question, but something I'm thinking about just in general about the macro environment.
Yeah, we're going to see how resilient the American consumer is with this. The cost of tariffs going to be passed on to the buyer, or are the manufacturers and the dealerships eating a bit of that? And if so, then doesn't that mean that we might see the return of 0% for 72 months at some of the captives and so on? So I'll say that the macro could fundamentally shift a lot of the demand for auto loans, maybe even away from banks and credit unions. That's possible. It's kind of a wait and see attitude. I think what you do need to have, though, is a very flexible policy and a very flexible pricing structure. We used to set and forget at auto loans when rates didn't move all that much. And that was the wrong approach then. I think it's really the wrong approach now. I think you've got to be so on top of what's happening in the marketplace, what's happening with consumer behavior, and make sure that the loans you're bringing on are actually going to be profitable for your program. And maybe you make that choice to not try and be as competitive in the marketplace. I was talking to a lending partner last week in Texas, and they're just seeing where in a very highly competitive, large metropolitan market, they just couldn't see a way that they could remain competitive in that auto loan space. So they've actually backed out a little bit, and they're doing a lot more sort of internally with their own membership because they're a fairly large credit union, but they're not chasing a lot of that indirect business today.
Yeah.
And that doesn't mean that's going to be that way a month from now or even 2 weeks from now, but they've made that conscious decision. We're not going to chase rate right now, with valuations perhaps being a little higher than what they would be, the residual value, if it ever did come to a repo.
Well, maybe that's a good opportunity for them on refi, though, right? That if they're not going to chase rates on on indirect. They could potentially, though, make that deal on refi. You've got some payment history on the same car. You could offer a better rate there. And I do think it's just a product that a lot of people don't necessarily know about, too, is that can you refinance your auto loan? Like, it still seems like there's a little bit of education out there.
I think some people do know that, right? I have a really good example. A friend of mine purchased a vehicle back in January, the tariff unknown, right? Walked out of there, super prime borrower with probably like a 9% type of APR. Knew he could refinance that, of course, but he just wanted to get that trim package, that color off the lot that day. Then was able to refinance, 15, 30 days later at much more favorable types of terms. Do you think there's a lot of consumers out there that are knowledgeable that they can go do that? Because credit unions, of course, offer somewhere between 200-300 basis points lower than what they're offering in the dealership.
There's danger with that approach, though, right? I mean, how many people do you know got into houses thinking, oh, yeah, this is the house I want. Yeah, rates will turn. This is 6.5%.
Value will stay the same, but rates will change.
And where are we now? 30s are still above. So we haven't seen a 30 above or below 6% in quite some time, right? And or maybe things change with your financial profile. Now you're not as super prime as you were before. So I think that is a bit of a risky proposition. To answer your question, Drew, though, yes, I think there's a segment of borrowers that inherently understand that. And in your friend's case, he's like, no, this is one I want. I'm not going to wait. I'm going to get it now while I can, because who knows if that particular model with that trim package is going to be available when I'm ready to pull the trigger 6-12 months from now.
On that, going back to a point that you made, Barry, that credit unions are kind of pulling out of the indirect space, not chasing rate. However, credit unions are now matching market share of that of banks. Why do you think that is if they're not chasing rate, knowing that credit unions have more competitive rate offerings because they're more member-based rather than shareholder-based?
Yeah, I'll say, look, some have made the choice to maybe not chase rates, whereas for others, it's the bread and butter, and it's sort of maybe a fundamental or the primary product that helps them from a profitability. But look, you and I know from our credit union experience that you may not necessarily make a whole lot of profit off of the loan itself. It's those add-on products. It's GAP. It's the mechanical breakdown insurance, things like that in an indirect relationship for the credit union, that's where I think the real value comes from. And then, of course, now you've got that brand new member that you can maybe sell that second, third product to as well.
Or you can start them out with a personal loan and then refi their auto into a better deal.
Many paths to get to that.
Which is first and which is second. Yeah,
for sure.
Definitely. All right, so thinking about this surge of auto refinance demand, right? We've heard this for the past 2 or 3 years, this L word of liquidity, and it being an issue for credit unions and even in banks in some aspect. Things are starting to come back in line, but we still hear quite often that there's liquidity pressures and concerns. If we have this surge of demand, how do you think credit unions are going to be able to take their capital and put it to work, or they're going to have different avenues of being able to, going back to no pun intended, drive additional auto loan growth?
Liquidity is still a concern out there. Certainly not like it was 2 years ago after a couple of spectacular bank failures that occurred. Like when you're sitting in that lending professional's chair, there's a little bit of a hope and a prayer that perhaps if you come to an inflection point on your balance sheet, that you're able to either bring new deposits in at a lower rate, or perhaps Fed funds rates are a little lower, so your borrowing costs are a little bit less. My credit unions, we tended to maybe take more of an approach of let's try and get as much as we can now at what rates that we feel are going to be meaningful and desirable for the credit union, and sort of worry about how to sort of fund it after, knowing that you can sort of turn that spigot off, especially on the indirect. On the direct side, it's a little more difficult. You want to have dollars available for those direct members who are coming to you. They want to deal with your institution for an auto loan. So, we better make sure we've got some dry powder to be able to fund those.
Yeah. And I definitely think the efficiency of underwriting products like auto refi is helping, right? Like the cost of customer acquisition isn't as high with digital channels. The, kind of cost per funded loan to convert a refi application, particularly if you're partnering with a vendor that can offer a digital experience and, remove as much kind of manual intervention with both the refi, the retitling, the increase of electronic lien entitling in states and how that's continuing to grow. whether it's electronic liens or whether it's e-notarize and remote online notary sorts of services, that the cost to originate each, whether it's an indirect loan or a direct loan or a auto refinance, I think the cost to originate each loan is depending on how you're doing it, can certainly be declining.
And on that, when you think of when this surge does come from an operational perspective, you have to probably put more FTE towards all of the operational pieces of lien transfer, payoff, things of that nature, right? Do credit unions, are they going to automate that in some fashion through third-party vendors? Are they going to have to hire more staff to be able to support this? What's the overall cost going to look like from that perspective with third-party vendor versus, in office staff?
In-house. Yeah, I think it's one of those things that, we've talked about a lot with a variety of other products. Like, you can certainly choose to partner to do that. I mean, you don't have to build it all yourself. But if you are building it and running it in-house, you can theoretically do it with less people than you would have had to do 10 years ago. You may not have the need to, vault paper copies in office, but there's any number of vendors that they could partner with at this point, even if you're doing the originations yourself, to do that electronic lien transfer, titling, maintenance, middleware solutions, ELT vendors specifically that know the rules in various states, especially if you have a national footprint and that, Michigan just switched to take e-notary, and now, they used to require a paper signature. Those sorts of very specific, even county specific rules sometimes get very nuanced. And so I think you really have to make that decision. Do you want to build and staff for all of those things and then try to monitor all of them? Or is that a better option to partner with a vendor who does that as their kind of core competency?
Yeah. 10 years ago, that was people, systems, tasks, then auditing of that, right? The whole risk management and compliance elements of it. And now those resources can be allocated for other operational aspects of the lending relationship. It's not to chase down titles. It's not to deal with DMV. It's no longer necessary in some of these states.
And that speed gives the member a good experience of, hey, I'm refinancing my loan. Do I make my payment with this bank or credit union that I already had my loan with? Now I know that things are happening much quicker and you're just more comfortable. Going back to the whole point of this surge coming and having the capital, what are your thoughts? I know we talked a little bit about kind of margins being very thin with captive rates. Do you think most credit unions or many credit unions are going to try to off what's on balance sheet right now, not yielding much from a sale perspective, participation perspective, and then front loading with these higher APRs than what they were, 2 or 3 years ago? Love to get your perspective on, is that kind of a combo of a capital mix, or?
I mean, that's a great strategy. If you're liquidity challenged, it's an excellent strategy, especially in that case. A lot of consumer lending professionals, I think, sort of look at I've got that loan, I don't necessarily want to give it up. Not many are sort of churning their portfolios in a way from both a risk management and a liquidity management perspective to sort of make sure that what's on the balance sheet is really sort of hitting what the income statement requires right now. I think that's kind of an elevated approach that all credit unions should be considering because there's certainly a market for it. While some credit unions, professionals that I've spoken to, are having no problem with growth this year, 25 has been abundant for auto loans. In fact, in some cases, they're like, no, we're good. We're way ahead of plan.
Well, how much is this? The Q1 tariff unknown, right?
Sure.
Well, maybe. And so maybe that was part of it, why there was a bit more demand. And, credit unions traditionally, as you get into third and fourth quarter, it's like, gee, we should pack our balance sheet a little bit more. So let's get out and buy some in the secondary market. And the secondary market always gets a lot more active sort of in the second half of the year. But yeah, I think that strategy, Drew, is a really, really sound one.
Well, if today's episode got you thinking differently about auto refi, connect with myself, Lynn, or Barry on LinkedIn. We're always up for continuing the conversation and hearing how credit unions like yours are putting ideas into action. All right, it's time for Fact or Fiction, where we're breaking down real opinions about auto refinancing and deciding if we're on board or not. So first question, there's probably some differences of opinions here. Only large credit unions can compete in the auto refi space.
Capital F, fiction. That's a little harder on new and used auto. Let's be honest. In the indirect space, at least in my former geographic market in Southern California, there were just some large institutions, both bank and credit unions, that would tend to sort of buy rates on the indirect side. On the auto refi side, no, this is game for everyone. If you have the right partner, if you have the right processes and systems in place to sort of not only find those refi opportunities, but price them accordingly, I think this could be profitable. Whether you're a $50 million credit union or a $50 billion credit union, you could do it.
Yeah, I think the second part of that is what I'd probably lean into. Like, if you can either find the right partner or build the scalability. Like, even for refi, if I think indirect, direct, much, you've got to have the relationships with the dealers and different for a smaller organization. But even for a smaller organization, that maybe that bread and butter auto refi product where they're offering it to their members or marketing it to whether it's their select employer groups or their community, being able to then actually build the operational efficiency, and whether you do that yourself or you're partnering, I think that's going to be key for them to be successful, to make the margins work.
All right, second one. We've talked a little bit about this with potential of chasing rates, not chasing rates. Rate shopping has made auto refi a race to the bottom.
I think I'd actually challenge that and say fiction, because I'm not confident that consumer behavior really they shop around that much. Are you offering them you only need to beat the rate that they have today. You don't need to beat every rate in the market. And if you have that relationship, particularly if you have a relationship with the member, and you're doing this, campaign out to kind of cross-sell, deepen relationship with your existing members, are your rates better than what they already have? And can you use data to answer that question, right? Like, you presumably may have their DDA data. You can do, soft credit pulls. Can you get an idea of what the average rate is on your consumer base and then market below that? Doesn't have to be the actual bear market minimum, but it has to be below where they are today.
Yeah, agreed. I also agree it's fiction. On the deposit side, I can go and find rates very easily through some simple Google searches. It's a little more opaque on the auto refi side. I almost have to go institution by institution because of risk-based pricing and because of the value of the vehicle and the LTV. And, there's a lot of different factors as opposed to here's a CD, here's the term I'm looking for. So I think that that consumer, that borrower is less rate sensitive. It's more about, are we providing that offer to them in the right method that they're looking for at the right time of what they're looking for, and is there enough value either in a lower rate, maybe a lower payment, or maybe a lower term. Maybe I want to pay this off a little faster.
I was just about to ask, do you think the consumer even knows what their rate is most often?
Probably not. They know what the payment is.
Yeah, they know their payment, but even term, like like, is it 38, 36, 48?
Yeah. Who cares at that point, right?
Yeah.
So on that, rates, rate offers beat trust in attracting refi customers.
Rate offers beat trust in attracting refi customers.
I would say fact. I think while you don't need to race to the bottom on rate, because to Barry's point, it's more opaque and harder to get to a kind of general refi market rate number. If a consumer believes that they can get a better loan, whether it's a lower rate, some sort of better terms, lower payment, even if that extends maybe the term of the loan. If they don't know your organization well, they still may accept that offer if you've presented it in a way that's compelling, and then may deepen that relationship with you. I don't think they need to start with that relationship to then select the auto refi product.
Yeah, not a lot of credit unions are contacting their members and saying, hey, we can lower your auto loan rate for a loan that's already on their books. That tends to not happen unless there's some compelling reason to do it internally, whether it's from a relationship building perspective that, hey, Drew, you're paying 8% now, I can get you down to 7%, even though in some respects I'm cannibalizing a little bit of my own income stream, but maybe there's a reason for that. Maybe it's to deepen that relationship, or maybe there's a spiff for Drew, like, hey, if you take this product, or, like a second product, or some other way of sort of building that relationship. There's got to be value in it for the credit union to do that. But the refi market, let's face it, it's basically I'm taking your loan.
Yep,
And then Lynn's going to take my loan, the next time rates. That's kind of the way the market works, predominantly.
All right, last one here is auto refi is a volume play, not a retention play.
I would say that's a fact. I think that someone who's looking to refi their loan certainly isn't loyal to the whoever originated that loan in the first place. So on the buy side, as I'm trying to get more auto loans into my credit union, that's just the more volume I can get that's going to be profitable, then it really is more of a volume play.
Yeah, I'll second Barry, nothing to add on that one.
Awesome. Well, thank you for tuning in to this episode of Leaders in Lending. We will see you next time.